Nifty companies have reported their Q4 results, and yes, corporate earnings momentum have continued in Q4. The COVID second wave impact is likely to be felt in Q1 and probably even in Q2. However, quite a lot of the analysts, industry players rather, do state that the impact of the COVID wave is likely to be slightly lesser than the first wave. Speaking about the Q4 earnings, well, the corporate earnings momentum did continue in Q4. We have already seen a good earnings momentum in Q2 as well as Q3. Demand recovery was also seen in Q4. However, we may see some impact of high input cost as well as commodity prices inflation to impact some of the sectors in FY22. ED Now scorecard does suggest close to around 30% of the Nifty earnings by weightage reported results that were above consensus expectations, and nearly around 13% of Nifty by weightage reported results which were below expectations. Approximately 23% of Nifty earnings by weightage reported results which were in line, and 34% results were mixed. We did see strong earnings coming in from sectors like IT, private banks, and within the PSU banks, SBI reported fairly strong numbers. Metals, healthcare sector, cement, consumer durables, oil and gas, as well as utilities were some of the sectors which did report strong earnings momentum. Some of the key trends in Q4 have been that, first of all, on the IT sector, we did see strong deal momentum, strong growth, and large players like Infosys and TCS have already stated and guided for a double-digit growth. Metals saw upgrades, deleveraging continued. Banks in Q4 reported gross NPAs which were lower than the pro forma GNP of the last quarter, and they did report pickup in growth. Autos did benefit on account of the low base and strong global recovery, but high input cost may impact some of the margins there. And consumer sector also did report strong demand recovery, with quite a lot of players reporting good volume growth, but input price pressure may impact margins going ahead. Cement did report strong demand along with healthy margins. Oil and gas, led by the OMCs, benefited from inventory gains and higher GRMs and marketing margins. In fact, Motilal Oswal does state that the top upgrades were for Tata Steel, JSW Steel, Hindalco, Axis Bank, Dr. Reddy's, as well as Sun Pharma. And top downgrades have been BPCL, IndusInd Bank, Titan, Cipla, Maruti, as well as Bajaj Finance. This is as per Motilal Oswal. In fact, they also state that corporate earnings in Q4 were led by cyclicals and a combination of low base and strong demand revival as economic activity improved. Corporate India displayed tremendous resilience in FY21, with the Nifty ending the year with a healthy 14% earnings growth, which was unthinkable a year back. The second COVID wave in April-May has slightly soared the sentiments and impacted the activity, and since the restrictions have been localized this time and less stringent, they do expect the impact in Q1 to be contained. They expect earnings momentum to accelerate in FY22 as the pace of vaccination picks up and the economy gathers further pace. BFSI and commodities are expected to drive the FY22 earnings. The market has been strong and largely looked through the COVID second wave on the back of strong liquidity and robust participation from non-institutional investors. The recent commentary by the Fed on earlier than anticipated tapering and India's elevated CPI print has rattled some nerves, even as equity bond yield dynamics are not showing any red flags. And I guess this is a fairly important statement. They state that Nifty valuations at 21x FY22 EPS are rich in demand, consistent earnings delivery ahead, and in their model portfolio, Motilal Oswal is overweight on BFSI, IT, metals and cement, and they are neutral on consumer, auto, healthcare, capital goods, and they are underweight on oil and gas and infrastructure sector.